This is something, of course, Dwight, that you have to look at in order to decide if you're going to grant a loan or not. And that is when the cash flow easily supports the new debt.
Well, yeah, so if you're looking, buying a rental or a multifamily or something like that, I mean, it's so much easier. We rely primarily on the appraisers, on what the typical unit or units will generate. So if your payment is
Wow.
$1 less than what the total rents received approved, and then you have to, along with that, go with the stress test. You have to make assumptions, whether or
What do you
not
mean
you're
by that?
gonna whether or not you're going to have drop in rents. You're starting to see that a little bit, those cracks in northern Nevada right now. And then always got to factor in the vacancy factor, John, like you said, on any property, anything you do, you got to make sure that it's going to cost more. I mean, Fannie and Freddie use 25%, but that's kind of heavy, but it's always going to cost more than you think when you get a vacancy, especially if they leave the place in not such a
Okay,
good
so that's
good
that's a
way.
real interesting point you bring up. So you're saying Fannie and Freddie, if they are the ones ultimately buying the loan, in the calculations you have to present to them, they assume a 25% vacancy. That's
Right.
huge.
And
Yeah.
you can argue in Reno, even anywhere in northern Nevada, that it's way less than that, but you can't get away with it. They use 25. But I guess that's good because then and really, John, in simple terms, just says if you're getting $1,000 in rent, I can only give you 750
Right.
to
Right.
offset the
There you go.
payments. So I mean, it gives them a little bit of a, I guess, a little bit of a buffer zone.